Here's a simple strategy that you can use to pay off your mortgage faster and pay less taxes at the same time. Yes, that's right, less taxes. It's called a debt swap, and it's a move that most homeowners don't even know that's possible. Let me break it down for you in plain English. Bad debt versus good debt. Now, you've probably heard people talk about bad debt versus good debt. Bad debt is money that you borrow that doesn't grow in value and doesn't give you a tax break like most mortgages. Good debt is money that you borrow to invest, to buy assets that can grow in value and let you write off the interest at tax time. The trick that we're talking about today is turning a chunk of your bad debt into good debt. And once you do that, you can start getting tax breaks while paying off your home faster if that's what you choose that you want to do. The example, how to set this up. Now, let me show you how it works with some really simple numbers. Let's say that your home is worth $600,000. You still owe $350,000 on your mortgage. Now, you also have $40,000 sitting in a regular ETF account, just a basic investment portfolio, not in your TFSA or RSPs. How a HELOC fits into all of this. Now, because your mortgage is only at $350,000 and your house is worth $600,000, your bank might let you borrow more as you have more equity. You can get a HELOC. Now, let's say that you get approved and you can borrow up to $40,000 on that line of credit. The three-step swap. Now, here's where the swap happens. Step one, you've got that HELOC, so you borrow $40,000 from it. Step two, you already have $40,000 sitting in an ETF. Now, you sell those investments and you use that money, and you pull when you pull it out, you're going to be paying off your HELOC. You also have that money from the HELOC, which you're going to use to buy back those investments. In the end, you still have your investments, but now that $40,000 of debt that helped you buy them back, that's tax-deductible debt because you borrowed specifically to invest. Tax benefits and mortgage paydown. Now, let's say that your HELOC rate is at 5%. That's $2,000 of interest in a year. But because it's investment related and your tax rate is 35%, you could get $700 back from CRA. Instead of spending that refund, you could throw that $700 directly onto your mortgage. And if you do that every year, it could shave about 5 years off of a 25-year loan. All from just probably what it takes maybe an hour to set up. Here's a real life example and for relatability. Now, one couple that I worked with, Sarah and Omar in Burnaby, they did exactly this. They used their HELOC to do a $40,000 debt swap. They got $2,800 in refund in year one because they added some dividends on top of the write-offs. Now, that refund, it went straight onto their mortgage, and they're now on track to be debt-free 5 years earlier. They call it the invisible snowball. Risks and reality check. Now, this isn't magic and it's not for everyone. And if the market drops, will you panic sell? You have to keep about 6 months of emergency savings so that you don't have to and you don't get into that position where you have to sell. Now, two, if the rates go up 2%, can you still comfortably afford the interest? And finally, track every move. Create a simple spreadsheet with the date, the amount, and one investment that you bought. That way, if CRA ever asks questions, you're good to go. Your next step. So if you're sitting on non-registered investments and you've got room on your HELOC, this could be a game changer. Here's what to do. One, check how much space that you have available on your HELOC. And two, add up your taxable investments outside of an RSP and a TFSA. If you want help, just DM me the word swap and I'll walk you through it in more detail, or hit the link below for a free 15-minute call. So that's the debt swap, one of my favorite strategies for paying down a mortgage smarter, not harder. Next week, I'll show you a trick for business owners called cash downing. Subscribe so you don't miss it.